You're watching the wrong number. It's not the price of a stock, or even the balance in your banking app. The number you've been taught to trust is an illusion of access. When the next financial crisis hits, the only number that will matter is your position in the line to get your money out. That's the moment your screen refreshes and nothing changes. And for most, that position is last. Imagine trying to make payroll or a down payment on a home, and the transfer is simply marked pending. You feel that hollow click in your stomach. It's not a prediction. It's a mechanical problem that has already happened. You saw the lines outside Silicon Valley Bank in 2023, but the real story was the thousands of business owners at home hitting refresh on their banking app, staring at a spinning wheel of denial. Their money was there, but their access was gone. In a single day, $42 billion in withdrawal requests were triggered, shutting the doors by sheer physics. This isn't ancient history or a black swan event. It's a design flaw that repeats itself. We saw it in 2008 when the global economy had a heart attack, freezing the hidden plumbing of the system. And right now, echoes of the same stress are appearing, with liquidation cascades putting pressure on the system's core. The story you're told about market panic isn't the full picture. The truth is, a chain reaction has already begun deep inside the system's pipes. That is what decides who gets their money and who is left holding an empty bag. So, let's follow the money and see where it really goes. Most people think money simply disappears in a market crash. They imagine it vaporizing, like poof, it's just gone. This is the single biggest and most dangerous misconception. Believing it leaves you blind to the real danger. The money isn't gone, it's trapped. The real problem is a fundamental flaw baked into the architecture of modern banking: duration mismatch. It sounds complex, but it's a dangerously simple idea. Banks take our short-term deposits, money we can demand back at any moment, and lock them into long-term assets, like 10-year government bonds or 30-year mortgages. Think of it like this. You borrow your friend's car for a quick trip to the store, but then you drive it across the country. If your friend suddenly needs their car back for an emergency, you have a serious problem. You can't just teleport it back. So why do we assume our banks can? That's exactly what happened to Silicon Valley Bank. They took massive, instantly withdrawable deposits from tech startups and bought long-term government bonds. When interest rates rose, the market value of those bonds fell sharply. When the best connected depositors got nervous and pulled their money first, the bank was forced to sell those bonds at a huge loss to pay them. The more they sold, the bigger the losses, until the system broke. The money didn't disappear. It was trapped in devalued, long-term assets. This isn't an isolated bug. It's a feature of the system. And when stress hits, the exits are sealed. Your deposit is still technically on the bank's books, but your access to it is frozen because the bank is stuck trying to sell assets that nobody wants to buy. To really get this, picture the financial system as a complex network of water pipes. On a normal day, money flows. In a crisis, valves start slamming shut everywhere. A series of invisible chain reactions begins, and this is how your money gets stuck. First, you have the classic bank run, but at the speed of digital light. SVB saw withdrawal requests for $42 billion in a single day, something that would have taken weeks in the past. It's not just traditional banks. Even modern payment apps can suddenly halt transfers or freeze accounts, citing unusual activity, the very activity a crisis creates. Your money is there 1 minute, and the next it's under review, trapped behind a customer service wall. And here is the critical detail everyone misses. By the time you read a headline about a banking panic, the exits have already been sealed for hours. The game is over before most people are even told it has begun. While you're reading the news, other banks are hoarding cash, refusing to lend it out. The pipe connecting banks to each other gets clogged, draining liquidity from the entire system. Second is the collateral and margin call chain. When the price of an asset drops, leveraged traders get margin called. They have to post more collateral or their position is automatically sold. We've seen liquidation cascades where billions in leveraged positions are wiped out in a day. Each forced sale pushes the price down further, triggering the next wave of liquidations. It's a domino effect where each domino accelerates the fall. Third, there's the forced asset sales chain. It's not just failing banks. Stablecoin issuers, to maintain a one-to-one peg with the dollar, hold vast reserves in US government debt. If a wave of redemptions forces them to sell those treasuries in a hurry, they can flood the market. This fire sale pushes down the price of what's considered the world's safest asset, sending shockwaves through the entire system. Finally, all of this creates the liquidity reallocation chain. Money doesn't sit still. It runs for safety. Capital flees risk and desperately tries to get into short-term government debt. But not everyone can fit through that exit at once. The pipes leading to safety get jammed. Your money is stuck in the queue, trapped in a system seizing up because everyone is trying to do the same thing at the same time. And the longer that queue grows, the more the system is forced to choose who gets liquidity and who gets locked out. It's a massive interconnected sink. The water, your money, is still there, but every drain is clogged at once. And while everyone is staring at the swirling water, they're missing the real question. What happens when the sink itself shatters? Understanding this puts you in a very small minority. Most people are watching the price. You are learning to watch the pipes. That's the difference between being a spectator and being prepared. The most terrifying part of a financial freeze isn't the slow leak. It's the instantaneous shatter. Financial systems don't bend, they break. One moment, liquidity is flowing. The next, it's a sheet of ice. This is the physics of the system. It's called a nonlinear trigger. It starts with one margin call in a forgotten corner of the market, a forced sale. The price dips. But that dip triggers 10 more margin calls, instantly. 10 more forced sales hit the order book at once. The price doesn't fall, it gaps down. Now 100 counterparties are liquidated simultaneously. It's not a chain reaction. It's an explosive decompression. Each sale doesn't just fuel the next, it multiplies it. Until the bids on the screen don't just thin out, they vanish into thin air. What usually unfolds over months begins happening in hours. Confidence isn't falling, it has vanished. The fuel for that acceleration is trust. At SVB, the trigger was one announcement of a loss. That single piece of data didn't just cause concern, it erased confidence. And our system is built entirely on that assumption. Once trust in a counterparty's ability to pay evaporates, it doesn't degrade, it's gone. In that moment, the system defaults to zero trust. SVB wasn't a black swan, it was a predictable failure point. The 2019 repo market crisis wasn't a fluke, it was a fire drill for the exact same failure. A temporary cash shortage caused overnight borrowing rates to suddenly spike from 2% to over 10% in hours. Banks simply stopped lending to each other. The pipes froze instantly. The New York Fed had to inject billions daily just to unjam the machine. These aren't accidents. They are built-in features of the architecture, waiting for the right stress to manifest. If you're starting to see that headlines about panic are a distraction from the real story, then you're already ahead of 99% of people. Understanding this hidden plumbing is the first step. And if this is making sense to you, take a second to hit the like button and subscribe. We explore how the system really works, because that knowledge is your best defense. So, if the traditional system can freeze, what's the alternative? For years, the promise of crypto has been permissionless settlement, the idea that transactions are final and unstoppable. The money flows through an open river, not a gated pipe. In the old world, settlement is a hierarchy. A stock trade takes 2 days to clear because a chain of intermediaries has to approve it. And in a crisis, who gets access first? Think about your last wire transfer. the paperwork, the 3-day hold. Now picture an institution with a direct line to the central bank's discount window, pulling $10 billion with a keystroke. While your mortgage payment is stuck in a queue marked pending, they are the queue. Your access is a retail request. Theirs is a system-level priority. At the protocol level, a Bitcoin transaction is final. This isn't about price, it's about physics. Once confirmed, it cannot be reversed or frozen by a central party. This offers a profound architectural alternative to a system full of fragile permissions. However, that unstoppable narrative is getting more complicated. New regulations are creating new gatekeepers. In the European Union, the MiCA regulation is creating a full framework for crypto. More impactful is the tax reporting rule, DAC 8, which will require crypto service providers to collect user data and report transactions to tax authorities starting in 2026. These rules introduce new compliance choke points. This is the new chessboard. While most are still watching the price, you are now tracking the gatekeepers. You're not just a passenger in this system. You're learning to read the map. The underlying blockchain might be a river of final settlement, but the on-ramps and off-ramps, the exchanges and services we use, are becoming gated bridges. They are the new valves. This doesn't erase the value of final settlement, but it does mean your access still depends on which pipes you're using. When the system freezes, your money doesn't disappear. It gets trapped. It's trapped by a duration mismatch on a bank's balance sheet, caught in a liquidation cascade on an exchange, or stuck in a settlement queue behind billions of other dollars trying to flee to safety. The headlines will blame panic because it's an easy story. But you now know the real cause is mechanical failure in the hidden plumbing. The conversation is no longer about traditional finance versus crypto. It's about a much more fundamental divide. Systems that offer the promise of access versus systems that deliver final physical settlement. For the small group of people who understand this distinction, knowing the path your money takes, the pipes it flows through, and where the new valves are being installed, that isn't optional. It's the key to protecting your access to what is yours. But this all raises an even bigger question. What happens when the demand for safe final settlement massively outstrips the capacity of these systems? What happens when a global run for the exits overwhelms not just the old plumbing, but the new plumbing too? That's what we'll explore next. Subscribe and turn on notifications. And find the one person you trust to have this conversation with, and send them this video. Understanding the plumbing isn't just about protecting yourself. It's about being prepared for the people who depend on you. It's a conversation that needs to happen before the pipes freeze. See you next time.